Hey traders, welcome to our Sunday live look at the market. I thought I'd check in with y'all this Sunday. I am looking at the markets, looking at some charts. We have a quirky little half day going on tomorrow, so it's not that we don't have a trading session, but I'm going to tell you something right now. It is not one that I would recommend that we do a lot of active trading in. I'll be curious to see what the intraday action looks like tomorrow, but mostly I'll be spending tomorrow looking at the way in which the first trading day of the new quarter, the first trading day of July looks like. So ultimately, I just want to take a few moments to go through some of the major indices. If you have any questions, feel free to type them on in. I will do a quick charts and coffee before we hop into the Sector Secrets Mastery room tomorrow and get our first trading day of the new quarter in the books. And then also we do have some swings that we've got our eye on, as well as a watch list that we're going to continue to fine tune for what seems to be some fairly decent risk appetite as we kick off the second half of the year. By the way, I do want to mention, and the sale goes on for I think a few more days, but if you've been looking at the hourly price movement ranges, my recent daily price movement range class, so those volatility indicators, or if you're just looking to join me in the Sector Secrets Mastery, anytime there's a sale and a pretty darn good one, I like to let you all know. And right now, I think all of that is 30% off, which is pretty bonkers. So if you've been looking at that and thinking, all right, Rog, I'm ready to take advantage of the sale, yeah, do it, gang, because I think it might be over Thursday or Friday. I'm not 100% sure. If you head on over to the website, you'll be able to check for sure when the sale ends. But yeah, please don't miss it if you've been on the fence about anything. All right, so let's get into what's going on with the S&P, NASDAQ, Dow. Let's take a look also at the Russell. So let's take a look at all the the three major indices in the Russell. And let's take a look at some bonds and dollar too to kick this off. MG mentioned I'm still waiting for the market money math course to go on sale. MG, you know what? Call the office up. I think they'll be there for the half day. I don't know if it's not on sale or not, but I'll tell you this. We go over sort of the evolution of the market money math approach in the Sector Secrets Mastery. In fact, that's one of the first things that you get from me when you're part of the mastery. We talk about the Holy Grail process, which is the market money math. So we continue to evolve that. We have a spreadsheet about position sizing and risk around my market money math approach. So all that's built into Sector Secrets Mastery. So I will say, I don't know what the sale price is on that program, but I can't imagine it's going to be much different than hanging out with me for I think a quarter in the mastery. So it just might be a better bang for your buck. So I'm throwing that out there, but call the office up. Yeah, call them and tell them, hey, this is what I want. Find out what you can get into the mastery for, and then compare that to the class. So you might find you're just better off coming and hanging out with me in the mastery. So I just wanted to give you that thought there. All right. So as we're taking a look at what's going on with the S&P, gang, keep in mind that as we take a look, and you'll see that tiny little candle that's plotting right now. I mean, yes, we are going to have an open market tomorrow for a half day because we can't have two closed trading sessions in a row on the weekdays, right? We can't have a Monday, Tuesday, Wednesday, right? We can't have sequential days off in the markets. And why would we anyway? But anyway, but if you take a look, here we are opening up near the highs, if not just above the highs on the S&P. And I'm going to talk to you all about a little sector rotation. I touched on this in the free video on Friday, which you can catch at the Simpler Trading YouTube channel, that certain sectors participated in Friday's move. Actually, certain sectors participated in the days leading up to the end of the month, the end of the quarter, which was very, very promising. And I say promising because it wasn't money going and hiding out. It wasn't money going under the mattress. It wasn't defensives. And I'll show you that in just a moment. So while we can speculate about what could happen, we're better off doing what I did. And those of you that get This Week in the Markets newsletter knew that we had basically two different scenarios for rotation. Either the defensive scenario, which was XLE, XLRE, XLP, XLU, or we get this kind of quirky phenomena where the two lagging sectors in the S&P and the Dow, the financials and healthcare, would benefit from risk appetite. And it's that latter scenario that played out. So as long as those continue to move higher, these moves in the Dow and the S&P mostly, this is very promising for potential follow through, because remember, the number one sector in the Dow is our financials, and the number one weighted sector in S&P might be tech. It is, right? But number two is financials. So keep that in mind. Financials and healthcare do have quite a bit of influence on what happens with the S&P and the Dow. Now, in terms of any sector rotation out of tech, right, out of the NASDAQ, we most definitely did not see that. XLK had a pretty darn decent session. It wasn't really strong, but it wasn't as if we saw a lot of fear hit that sector. XLC held its own, as did XLY. So we didn't see a lot of necessarily a ton of bullishness out of those three, but we certainly did not see a bunch of weakness. These were strong sectors and a strong index for most of Q2, and Q2 ended that way, which means that rather than taking profit out of those corners of the market, traders said, we're going to stick with it, right? We're not going to go hide under a rock somewhere. We're not going to go hide in the defensives. We're not going to go, hide in cash or yields or whatever. We'll stick with what's been working, which is pretty darn interesting. So that's where we are. Now, the Russell might be a slightly different scenario, because remember, if there is sort of Russell did all right, don't get me wrong. And if financials, XLF, are moving higher, we would presume that could benefit regional banks. Look at regional banks, gang, and then think about the impact regional banks have on the Russell 2000. Right? We had that reconstitution, which benefited the Russell 1000 more than the 2000, because the Russell 1000 looks a whole lot more like the NASDAQ, right? That's the IWF. I don't trade that. I don't trade even the Russell all that much. But what I'm saying is the way in which the Russell 1000 is weighted with a lot of tech emphasis, and the way that the Russell 2000, the IWM, is weighted with a lot of regional bank emphasis. If there is a monster under the bed, if there is a dark at the top of the stairs, gang, it is some kind of looming commercial debt crisis concern as we go into the second half of the year. And that is likely going to land squarely on the KRE. And then that in turn is going to affect the Russell. By the way, if you think about the reverberations of KRE weakness, think about how the way March played out. Think about the way in which the KRE and the Russell sell-off impacted what was happening with the XLF, the Dow, and the S&P. The NASDAQ cared the least. Why? Because financials simply are not weighted in the NASDAQ futures. Super heavily weighted in the Dow, super heavily weighted in the Russell, right? And then, of course, the S&P has weighting too. And when that financials weighting outdoes what's happening in tech, financials will have to react to that as well. So I'm not calling for some sort of, that's not the reason I bring it up at all. Just keep in mind, there's a reason it seems money did not flow into the Russell and into the KRE, because if we are thinking, gosh, down the road, if there is something to be concerned about in Q3 in the second half of the year, what might it be? The thing that, not recession, by the way, gang, I'm not really, frankly, I'm not the least bit concerned about recession as a trader, because a recession would force the Federal Reserve to pivot. Right? It would force them to cut. Up goes the market. What else would they cite? Labor productivity goes up. Market goes up. So there's a lot of bullish potential ramification of a recession. The greatest of which is in 2023, we're really not seeing a rate cut priced in. We're seeing a hold, right? We got the hike in July, and expectations are for the September meeting for or we're likely to get that hike in July. Here I am talking as if it's a done deal. Yeah, we're likely to get the hike in July, and then we have no meeting in August, hold in September, and hold through the remainder of the year seems to be what's in play. Recession would probably change that hold scenario into a cut scenario. So remember, the Federal Reserve did not hike in June, kicked the can to July. We'll get that rate hike in July, and then it looks like we're going to hold. Again, not prognosticating, not gazing into my crystal ball. This is what's happening on the Fed fund futures, and this is what I'm going to use as a rate of change, a trackable, measurable thing to understand what's going to happen, at least what we think is going to happen. And remember, gang, what we think is going to happen is ultimately what gets priced in. Yes, I hope that makes sense. Okay, so those are the four majors. And I mentioned we talk about bonds. Bonds are interesting, gang, because when we take a look at the bond market, we don't see lower lows in bonds. Now, keep in mind, lower lows in bonds means higher yields. Higher yields means what? Expecting a more hawkish Fed. If we're getting a hike in July, and I'm talking about it, and we see it on Fed fund futures, gang, that's priced in. We know it. What's known is priced in. What's priced in really doesn't have a shock effect anymore. We've already adjusted to that reality. So then the question is, well, why aren't bonds moving lower to reflect that higher yield? They already have. They've already discounted that. Yeah. So now we're in a holding pattern, which really does emphasize this holding pattern that we're in, really does emphasize sort of the holding pattern that we're in terms of what we think Powell and company are going to do, right? If I'm not really sure if they're going to hike again, but I'm pretty sure they're not. I'm fairly certain they're going to hold, but I don't know if there's a cut. Doesn't it make sense that bonds should find a range? Because there's really no reason to be sending yields lower, which is to say that bond futures higher. And there's no real reason to be punching down to significantly lower lows because we're at the tail end of a tightening cycle, right? We're at the tail end, the home stretch of the hikes. So why not find a range? And that's exactly what we're seeing in the bond market. And remember, bonds love to front run the Federal Reserve by around 6 months. So if you go 6 months from here, bonds are saying we see status quo, and that's what the Fed fund futures are saying as well. So that's in line. I don't find that to be surprising. What's interesting is, and it's not really interesting or surprising, I should say. It's very interesting. It's not surprising when you think about the U.S. central bank is at the end of their tightening cycle, but the European central bank, this is the 6E, this is the euro, they're still on their climb, right? They're still hiking rates. They're still fighting inflation. They're still a few steps behind the U.S. in terms of that tightening cycle. So the euro will benefit from a hawkish central bank. Countries of a hawkish central bank tend to have stronger currencies. Countries of a central bank that favors lower rates, that's a dovish central bank or looser monetary policy, right? That's all the lingo around it. They tend to have a weaker currency. And that means a currency that's just about done seeing hikes. And that means the next move is a hold. And after a hold is a cut. That's going to show weakness. You want to know what the dollar's doing? Look at this chart right here. Take a look at the 6E. Take a look at the euro, because the relationship is an inverse relationship. So what do I mean by that? The relationship is if the euro is heading higher, the US dollar is heading lower. And not everyone has access to dollar index futures. You can look at DXY, you can look at UUP, but please remember, you are looking at primarily a weighted basket of currencies against the US dollar. And the number one weighted currency, 58% of that basket, is this thing right there. Euro heads higher, dollar heads lower, and that's generally the direction that we're seeing. All right. So that's kind of where I'm sitting in terms of why I'm bullish into the second half of the year, or at least into the beginning part of July. What I'm worried about, right, for the second half of the year, the commercial real estate crisis, that it's a refunding crisis, right? There's a lot of loans that are going to be looking for refinancing. And obviously, I can cite all the things that are not going well with commercial real estate, not to mention we're looking at significantly higher rates now than we were when those loans were initially made. That's going to spell for some problems, possibly some defaults, and that lands squarely right back on regional banks, which again, notice regional banks, not impressive in terms of any kind of move to the upside. Now, I mentioned I'd show you all some sector rotation stuff. So let me do that here real quick. And then if you have any questions, type them in. And if not, we'll just make this a nice quick session here on Sunday, just to make sure we're keeping our pulse on the market together. Keep in mind, we do have those sales running. Like I said, if there's been something you've been wanting to pick up, don't dilly-dally. If it's 30% off, definitely take advantage of it. The way I look at it is, if I can let y'all know you can save some money, that's more dollars going in to your trading account, right? Okay, take a look at the U.S. sectors here, and I'm going to show you a 5-day normalized performance, right? I know it's kind of weird to look at, but just look at the stocks that are, at the top of the list, right? XLRE, XLB, XLI. Take a look at the 1-day, right? That was what we saw going into Friday. As we ended the week, it's really interesting. XLE kind of ticked down a bit. XLF towards the end of the day ticked down, but don't look at the very right edge, right? Don't just focus on the right edge of this chart. You might say, Rog, what am I supposed to take away from this? Do you see that pretty much everything is going from the lower left sort of to the upper right? It may not be a straight line higher. It may be a little movement higher than sideways. But if you look at the far right and compare that with the far left, where it started on this graph, you notice almost everything sort of moved up. Gang, that's pretty good participation. That's pretty good risk appetite, right? It doesn't matter if it was tech up, sideways, but still up. And it doesn't matter if it was energy. I know energy doesn't look sexy, but it's high. It's basically about at where it opened for Friday's session. That's not terrible, gang. What we're not seeing are a bunch of sectors just taking a nosedive while a bunch of sectors are moving higher. Generally, they're all moving pretty nicely higher. And the stocks that the sectors that have the strongest stocks of the quarter in them, all of those are doing pretty darn well. XLK, XLY, XLC. So I'm not just throwing these ideas out there. I'm saying, hey, look, this is a rate of change view of these sectors, and this is what we're actually seeing. It's something measurable. All right. Okay, so that is what I've got on the radar right now. And let's see, let's grab a few questions before we call it a day. Jack mentions, I'd like to thank you for teaching about risk management, scaling in and out of trades. Jack, one of the first things we discuss in the mastery, it's the thing we emphasize. I call it the Holy Grail, not tongue in cheek. It is the Holy Grail. We talk about position sizing. We talk about scaling in and scaling out and budgets on trades, because, position sizing has to be based on risk and account size. That means that I could not possibly tell you how many contracts to trade, but I can give you the formula. I can give you a spreadsheet, and those are all part of the mastery. So I appreciate that, Jack. And thank you for seeing the value in that, because most traders skip that part. They want someone to tell them how many contracts to trade. They want someone to do all the risk management for them. And while that would be great, if I had a way to AI myself into that understanding for 700 members, that'd be great. But I can't, right? So what's the next best thing? What's the better thing, frankly? Showing you all that it is a formulaic approach, and therefore very much rinse and repeat. So love it. Is there a specific time I'm looking for this commercial debt to be due? Captain Jane, it's going to be towards the end of Q3. I don't think they're all falling due. They're not going to be the same date, right? That everyone has to look at their loans. But I'd say towards the end of Q3 is mostly what I've seen. It's going to be sprinkled throughout. And it's not necessarily the debt being due that's the problem. It's really the concern about defaults. That's really, if there's going to be a problem, it's really the concern for defaults, right? Okay, cool. So I think that we'll probably hear some rumblings about it now that we're past Q2, end of quarter. We're going into the second half of the year. At some point, in terms of just different aspects of the market rising to the top and meriting discussion on financial media. Really, I mean, look, let's face it. That's where these conversations start, right? When the broadest group of retail traders get worked up about something, it's because they're going to see it on TV, right? Not that that's what I want us to do, but that's where we know all that gets frothy, right? Okay, so I'd say towards the end of Q3, but this will not be the only time we talk about it. The upcoming issue of This Week in the Market's going to be dedicated to my approach to earnings, and then as we go into probably September, we'll circle back and see what the talk is about commercial real estate. But I don't want you all worrying about, like I said, the monster under the bed right now. Money, and we'll talk about flows in this upcoming issue of This Week in the Market as well. I'll talk about where the flows are because, look, the bottom line is, where are dollars going? People can say whatever they want. I look at where price is going. I look at where volume's going. I look at where those dollars are going. That's the truth. The rest of it's just subterfuge, right? Okay. What's my thought on Tesla? Sure, we can take a quick peek at that before we wrap up here. So Tesla, look, like a lot of the stocks in the XLK, XLY, and XLC, Tesla's an XLY. Of course, it's also in the NASDAQ and the S&P. I need a quick pullback before I can do anything, but this is very much a buy the dip, right? Dips would look like trading days that were Monday, the 26th of June. I'd love to see that kind of pullback, a retracement. We don't have a gap close yet. I don't know if we're going to close that gap around $234.50. That'd be cool. I don't know if we're going to revisit 240, but those are, so look, nobody knows where the market's going to go, but what we can do as traders, what I think our job is to figure out if markets get to a certain price, is that then actionable? So again, less about predicting, which is, let's face it, that's most of what analysis is. This is what's going to happen. This is where the markets are going to go. Pick your high, pick your low, pick your crisis, right? That's not our job. Our job is to say, if this does happen, the high, the low, the price, the crisis, what then is my response, right? So notice those folks that like to point out what the monsters under the bed could be. What's the plan? What's the symbol, right? That's where I want to be. So if we can close a gap here, that'd be great. If not, there's not a whole heck of a lot for me to do. You may want to keep an eye on 257. That could be interesting. It's a near-term volume ledge. Maybe that's in play, but just, I would be cautious tomorrow, although you might get the opportunity. I would be cautious tomorrow. Wednesday is really the start of the quarter and the start of the month. All right. Very cool. As always, gang, thank you so much for being here for our Sunday show. Check out our sale over at the simplertrading.com website. Like I said, it's 30% off everything in the store. So have a wonderful quick half day tomorrow. For all intents and purposes, not a real great trading day, but we'll see how the first half trading day of the quarter starts. And then Tuesday, we, of course, will be seeing the markets are closed in the U.S. Have a wonderful and happy and healthy 4th. And then I'll see you back on Wednesday in the Sector Secrets Mastery. I'll be doing a charts and coffee tomorrow, and I'll be doing a charts and coffee on Tuesday. So if you have any questions, I'll see you then. All right, gang, be good to each other.